Good evening, sir.
Very good evening, sir. So let be refreshed for within a minute. At 8 o'clock sharp, we'll start. So regarding this paper, what we have discussed in the last class was basically related to the banking, and from the banking perspective, we went on to discuss about the basics of banking, the roles that banks play, the banking system which is prevailing in the country, and also we went on to discuss about the legislations on which the banking business is being carried out in India, particularly the Banking Regulation Act, and some aspects of that Banking Regulation Act we also discussed in the last class. Now, coming to the first module in the banking itself, there is another part which is in the name of your e-banking. As you all are aware about the fact that in the modern day banking system, whichever banks are operating, all of them are heavily dependent on technology. Because as customers, we individuals or corporates, they want the banking services at their doorsteps, but they don't want to move to the bank branches. That is the reason why over the years, in the last 15-20 years, there has been tremendous improvement in the technological aspect of banking. And accordingly, many products are being offered by the banks in the form of e-banking products. So the concept of e-banking is highly important on our part to know, because we are going through the basics of banking and insurance. So this concept of e-banking, since is eminent in the banking system in the modern day time period, that is the reason why we need to have some sort of familiarity with this e-banking concept. Now, e-banking, as the name suggests, basically refers to the electronic banking. So if the banking services are being rendered by the banks through electronic mode, then we call it as the e-banking. And you can see that since 1996 till date, over the period of 25-26 years, the commercial banks in India particularly have come out with many e-banking products to ease the transactions of their customers. So nowadays, by sitting at our home, we can do the deposits, we can do the withdrawals, we can do the payments to the third parties. So all things are being done nowadays by sitting at home. No need to move to the bank branches. So in the e-banking process, whoever are the stakeholders of the banks, all of them are being benefited. And because we know that banks originally were being made for the purpose of providing short-term and medium-term loan to the industries, but in the latter stages after the liberalization era, the banks also started providing long-term loans to the industries. But the main focus of the banking institutions in India is basically to develop the small and medium-scale industries. Because large-scale industries, they do not that much dependent upon the banking institutions, because they know that if they want some more capital, monetary capital, they can raise it from the market, capital market also. By approaching the capital market, they can also raise the fund. No need to go to the bank. There are some other avenues being open for them, particularly for the large scale industries, by using which they can raise the required funds. So what matters for the banking institutions regarding the development of industries in the country is basically to ensure the development of the small and medium scale industries. And in the process of e-banking also, we can observe that the small and medium scale industries also get benefited tremendously along with the individual customers. So now I'm going to show you some slides through which we will observe how this e-banking has immensely benefited the different stakeholders of the banking services. Is it visible to all of you?
Yes, sir.
So Ajay already
Yes,
told
sir.
you the provision of banking services through electronic mode by using different electronic channels. Uh, whatever services are being provided, all of them together constitutes the e-banking. And basically, with the help of e-banking, the customers can access the data without any time limitation as well as without any geographical limitations. So there is no restrictions regarding the timing of the transactions, as I already told to you, because earlier what was happening, you need to visit the branch only during the banking hours. Now there is no concept like banking hour even in the non-banking hours, because banking has been transformed into a 24 into 7 into 365 days banking. So at any point of time, there is no time limitation for the customer. The customer at any point of time can access the data related to their banking transactions. Also, there is no geographical limitations. Then when we are talking about how this e-banking actually has helped the banking business to grow tremendously over these 25 years, for that we need to go through the advantages of e-banking. And when we look at the advantages of e-banking, we can look at it by identifying what benefits it has given to the banks itself, what benefits it has given to the customers, and what benefits it has given to the small and medium businesses, because their focus is to ensure the growth of the small and medium businesses. Because particularly if you think of India as a country, then it is the small and medium enterprises or medium industries which basically can help in generating a lot of employment opportunities, which is highly essential for the country. That is the reason why growth of the small and medium enterprises is highly essential for ensuring the overall growth of the economy. Now, if you look at the benefits of e-banking for banks itself, so with the help of e-banking, the banks are basically being able to cover a large customer base. So large customer coverage is being possible. Anybody wants to say anything? So
Sir, please
basically,
mute all. Please mute all.
who is the host? Please ask the host to mute all. Now is it audible?
Yes, sir.
Okay. So when we look at the benefits of e-banking to the banks itself, we can find that with the help of e-banking, the banks actually have covered a large customer base. So they are being able to attain large customer coverage because of the e-banking, because banking services since are now being provided at the doorsteps, at the convenience of the customers, or more and more customers are being attracted to the banking channel. And because of some government policies also in the last 10-15 odd years, you can find that almost all of us are actually being associated or actually being linked with the banking system of the country. Secondly, because of e-banking, the operational cost gets reduced. You know that because for operational cost basically means when you run a branch, you need to make payments to the employees. You need to make payments for the electricity. But when you are providing banking services to the customers at their doorsteps, so your operational cost is supposed to be lowered down, because if that much of services would have been given within the banking hour, then operational cost would have been more greater. So because of the e-banking system, also the operational costs have gone down or actually have been reduced. Then promoting their services and products internationally, because with the onset of the liberalization, since all the financial markets have been integrated together, now we are considering the world market as a unified whole. So every market are being integrated together. So internationally also they can do their business with the help of internet, with the help of the web technology. The banks can also do their business internationally, which is happening. That is the blessings of the e-banking system. since they have adopted the e-banking system, it helps them to promote their services as well as promote their products to the international customers also. Then increasing the customer satisfaction and providing a personalized relationship with customers. Automatically, the customer satisfaction will increase if they get all sorts of banking services at their home, at their doorstep. Then automatically their satisfaction will be improved. And also, there is a personal touch to the customers because of the e-banking system over internet, over SMS, over mail. You can directly come in touch with the customer, and no need of direct face-to-face with the customer, but in virtual mode you can have interaction with the customer, and accordingly the customers, you can provide a better personal touch to the customers. Then benefits for small to medium businesses. So because of the e-banking system, since the products of the banks which are specifically being offered to the business organization, like your cash credit system or your demand loan system or your advances system. So these are basically necessary for the small and medium enterprises. Since these can be provided electronically, no need to repeatedly go to the bank offices, getting the nod from the bank officers. There is no need. By sitting at their offices and focusing more on their own business operations, they can get all such financial services from the banks. So automatically it will help them to increase their efficiency level. Lower cost than traditional financial management mechanisms. So cost also definitely is going to be less because they don't need to move to the bank. They don't need to approach anybody. They don't need to bribe anybody, which they were doing earlier before the introduction of the e-banking. So accordingly, they can focus more on their business operations and they can efficiently carry out their business operations. If that happens, then automatically it will help in creating more employment opportunities. Then coming to the benefits for customers, first benefit is in the form of convenience. As I said to you, banking has been transformed into a 24/7 into 365 days banking. So 24 hours a day and 7 days a week, the services of banks are being provided to their customers. So as per their convenience, they can take the banking services from the banks. Transfer fees also has become reduced and there has been a faster circulation of assets. The speed also has come because of the introduction of e-banking. What time it was taking earlier, now within a very limited period of time, every transaction gets settled. You can also get a loan over phone or over a mail or on the by using the internet banking. You can also get a loan. No need to move to the bank. So automatically the circulation of assets becomes faster. So speed of services actually has increased. And then competitiveness, fostering competition in financial market. Because of the e-banking system, every banks, as I said to you in the last class while discussing about the principles of banking, service quality is a principle which all the banks need to abide by. The better the service quality a bank provides, the better is the chance that it will attract more and more customers. So that is the reason why they will operate in a competitive environment. Their competitiveness will increase. If competitiveness among the banking institutions will increase, then automatically they will be inclined to offer better and better customer services to the customers. In communication, as e-banking system basically uses the web technology, uses the information technology. That is the reason why the communication has become more easier, more convenient, and more better. Abolishing the uses of paper, so environmental benefits also the consumers get because there is no involvement of paper. As we all are now talking about the cashless transactions, the paperless transactions, no need of any paper in the e-banking system. So these are some of the benefits of e-banking. By looking at all these, we can easily say that with the onset of the e-banking, the banking companies actually have improved their efficiency level to a larger extent. And the banking companies now, since are operating in a competitive environment, which is ultimately benefiting the customers who are none other than the public in general. So these are the benefits of e-banking. So in this process, we have covered some major areas of banking, which is there in your first module. Apart from banking, there is another area which the first module has touched upon, and it is basically related to the insurance sector. Now, have some idea about the mechanism of insurance, there is a need for insurance, and how the insurance business is being carried out. We need to have some sort of familiarity regarding the mechanism of insurance at the hindsight or at the very first place. What this insurance is all about. We all are talking about insurances, and we know there is a need for insurance, but what this insurance is all about. The concept of insurance basically prevails because of the existence of risk. As individuals, as public, as an organization, every entity is being exposed to some risks. And by risk, we generally mean the chance of a loss, the chance of a financial loss. Nobody knows what will happen in future. If you think of a business organization, it is operating its business, but it doesn't have any idea what will happen to its business 1 year hence or 2 years down the line or 3 years down the line. Because the business itself depends on many factors, and any change in any of these factors definitely is going to affect the operation of business. So nobody had any idea what will happen in future. But it is the responsibility of everybody that they need to protect themselves from these kind of future uncertainties. Therefore, when we are talking about the concept of insurance, we basically say that because of the risk to which all the assets are being exposed to, the concept of insurance is necessary. Every asset has some economic value, and every asset is supposed to generate some revenue for its owner. The owner generates some revenue by using its assets, which it owns. Thing is that every asset is having a particular lifespan also. As a human being, we have a particular lifespan. Nobody knows up to what period we'll live, but there is a particular lifespan. The lifespan might be 50 years, might be 60 years, might be 30 years. Similar thing happens with all the assets. If you go on to purchase an air conditioner, you cannot guarantee that that air conditioner is going to be used by you for over 25 years or 30 years. Maybe after a year or two, the air conditioner might not work because of some exigencies, because of some future uncertainties. So every asset has some lifespan, and during that lifespan, the asset is supposed to generate the revenue. But the irony of the fact is that there is every chance that the asset might get distorted or might get lost or might get destroyed because of happening of some events or some misfortunes. You can say misfortunes or events. Those events can destroy the asset, either can cause loss to the asset, can distort the asset, as a result of which the asset will not be in a position to generate that much of revenue which it was earlier providing to you. So what as a owner of that asset will do at that time? So you need to protect yourself for those kind of situations. So those kind of situations basically are considered to be the adverse situations. So generally we say that to protect ourselves from any kind of adverse situations, we need the concept of insurance. And insurance is nothing but a mechanism which provides protection to the economic value of assets. You can take any asset. Your life is your asset. Your health is your asset. Your house is your asset. Your factory is your asset. Your shop is your asset. whatever jewelries you own, those are your assets. Wherever you have invested your money, those are your assets. So all your assets are basically having some economic value. And the mechanism through which you can give a protection to the economic value of those assets is considered as insurance. So in general, when we talk about insurance, we say that insurance is a cooperative device. It's a collective term. Cooperative device in the sense that all the owners who own same type of assets, they are being exposed to same type of risk. And all the owners, if decide to insure their assets, then the chance of loss to be faced by the owners might be a given percentage. It might be 10%, it might be 5%, it might be 8% like that. Suppose 100 number of individuals are owning some asset and they all are being exposed to a particular risk. All the 100 number of individual owners suppose have insured their asset against the risk to which the asset is being exposed to. But once the risk happens, the loss will not be faced by all 100 persons. It will be faced by a given percentage of the total number of persons. Maybe 10%, maybe 15%, maybe 5%, whatever may be. So in insurance, the concept of chance of loss is important. The concept of possibility of loss or probability of loss is important. So whenever you think of any insurance company and whenever the insurance company go on to provide some kind of policies to you, they first of all have to calculate this probability of loss. So without a proper calculation of this probability of loss, the insurance companies cannot function properly. And generally, what the insurance companies do, they undertake the risks to which your asset is being exposed to against some monetary value. We call that as the premium amount. And in case that risk happens, by way of undertaking the risk, with that loss. So you will get a protection for that. I am insuring with an insurer in case the risk for which I have insured the asset with the insurer happens and I am faced with loss, that loss will be compensated to me by the insurance company. With this, we need to do the insurances. That is the reason why we need to go for insuring all our assets, because we know that our assets are valuable to us. The asset might be in the form of life asset or in the form of non-life asset. If you think of life asset, then you have a type of insurance which we call as life insurances. If you have assets which do not have any life, like your house, like your vehicle, like your factory, like your godown, like your shop, then you will go for the non-life insurances. But overall, the mechanism of insurance, although is considered to be a cooperative device, but in financial sense, there is some legality being attached to it. Because on what basis the insurance company will give the promise to compensate for the loss that the owner is supposed to face in case the risk happens, for which the owner is supposed to do the insurance. So for that, some legality is being attached to the concept of insurance, as a result of which we can also say that insurance is also considered to be a legal contract. Now in contract, as we know, for a contract to be made, an agreement has to be done. So without an agreement, no contract can be made. And if the agreement is suppose can be taken up in a court of law, then we can call it as a contract. So legal contract. In every contract has to be the presence of minimum two parties. More than two parties can also be there. But since insurance is considered to be a legal contract, here also minimum two parties. One party is the insurance company. The other party is none other than the owner of the asset. So the asset owner has to be the other party. We call the other party as insured, and we call the insurance company as the insurer. So insurer and insured, these are the two different parties. That is why we can say that it is nothing but a legal contract whereby the insurer promises to make good the losses of the insured on happening of the insured contingency. The risk for which the insurance has been taken, in case the risk happens and accordingly loss arises, that loss will be compensated by the insurer to the insured. And the contingency is nothing but the event which causes a loss. It can be in any form. It can be the death of the policyholder or damage, destruction to the property, anything. And it is called a contingency because there is an uncertainty regarding happening of the event. You cannot ensure at what point of time the event will occur. And for promising this to compensate for the loss in case the risk arises, the insurance company is taking a charge, which we call as the premium. Now coming to the different types, as I already told to you, depending upon the type of asset, we can have different types of insurances. And the assets can either be in the form of life asset or in the form of non-life asset. Accordingly, we can have life insurances and non-life insurances. And we normally call the non-life insurances as the general insurance. So the concept of non-life insurance is considered to be broader as compared to the concept of life insurances. Because in life insurances, the subject matter of insurance is none other than the lives of the individuals who go on to insure their life against the risk to which their life is being exposed to. Here, one thing you need to remember that life insurance, along with providing coverage of insurance, also provides some investment opportunities, some investment avenues. So in case of life insurance, what happens? You have taken or you have insured your life against the risk to which your life is being exposed to, and you can insure your life against the risk for a definite period. The period might be 1 year, might be 2 years, might be 5 years, might be 10 years, might be 20 years, might be 30 years. So there is no restrictions in it. You can take for a long period as you wish. During that period, if the risk against which you have taken the insurance, or if the risk to which your life is being exposed, for which you have already taken the life insurance, and accordingly you are faced with loss, either in the form of damage of some parts of your body or in the form of death, then you will be then in case of damage you will be compensated with the loss, or in case of death, whoever are your beneficiaries whom you have mentioned as your nominee in the insurance contract, that nominee is supposed to get the benefit. But in case the risk does not arise during the time period, suppose for 20 years you have taken the insurance, over a period of 20 years, on an annual basis, you have paid 10,000 rupees per annum to the insurance company in the form of premium up to a period of 20 years. But after 20 years, suppose the risk does not happen. Within that 20 years, risk does not happen. You have already paid 2 lakh rupees over a period of 20 years, but the risk has not happened. Because the risk has not happened, so loss has not arisen. If loss has not arose, then automatically there is no need to pay compensation. But in case of life insurances, even if the risk does not arise, even if the loss has not happened, still then you will get back your money with some return over it. That 2 lakh rupees and some return over that 2 lakh rupees, which has been compounded over a period of 20 years, will be given to you. That is the reason why I am saying life insurance, along with coverage of insurance, also provides an investment opportunity or investment avenue. That is why we generally do not consider life insurance as pure insurances. If you look at the concept of insurance, then you can say the pure insurance is none other than the non-life insurances, or normally which we call as the general insurances. In case of general insurance, what happens? We generally go on to insure our assets other than our life, whatever assets we have, we can go on to insure our assets against the risk to which our assets are being exposed to. Here, the risks basically are related to some events. The event might be in the form of catching of fire, might be in the form of slippery of roads, or might be in the form of some natural calamities, whatever it may be, might be in the form of burglary by the burglars. So any type of event to which our asset is being exposed to, we can go on to insure our asset against those risks. But thing is that in general insurances, we can insure our assets only for a period of 1 year. We cannot do the insurance of our assets over a period of 1 year. And each year we need to renew it. That means every year we need to insure our assets. Whenever we go for insuring an asset, we can insure it only for a period of 1 year. And if during that 1 year period, the risk does not happen and accordingly no loss arises, then the money that we have contributed in the form of premium will automatically be lost. That will be taken away by the insurance company. This is the reason why many of us are not inclined to do the general insurances. Particularly, if you think of the health insurances, you can find that there is a large number of population in our country who have not yet gone for the health insurances, because they know that if they need to renew this health insurance each and every year. So each and every year they need to pay some amount of money, and if the risk does not happen, then their money will be lost. Suppose I have taken a 5 lakh health insurance policy for which I have to pay 10,000 rupees annually, depending upon my age, because the more the age, the more is the risk of health, and accordingly the more will be the premium. The less the age, the less will be the possibility of health disorders, and accordingly the less will be the premium. So suppose 10,000 rupees I have paid for a particular year, for 1 year, and during that year nothing happened to my health, so that 10,000 is lost. If I suppose do not go on to renew my policy in the very next year, then entire 10,000 is lost. It is gone. I need to renew it. If I can go on to renew it year after year, then whichever year of health disorders, at that point of time, this insurance is going to help me a lot. Same thing happens in case of motor vehicle insurances. Yeah, our motorbike, our four-wheelers, all of our vehicles are being exposed to some risk. Basically, the risk of being faced with an accident, the risk of damage, risk of fire, risk of theft. So many risks are there. But thing is that we can insure our vehicle against such risk only for a year. If during that year nothing happens, we have not faced with any accident, our vehicle has not been theft, there has been no damage to our vehicle, then that amount is lost. If we go on to insure it year on year basis, then only we can get the benefit whenever the risk happens. So in general insurances, the time for insurance is limited to 1 year, but the condition is that every year you need to renew it if you want to get the insurance benefit. Unlike life insurance, general insurance doesn't provide any sort of investment opportunity, but life insurance provides investment opportunity. So when we are talking about the general insurances, it can be of different types depending upon the type of asset as well as depending upon the type of risk, type of hazard to which our asset is being exposed to. Depending on that, we can have different types of general insurances. I'm just going to say you some of those general insurances. First one is fire insurances. Here, risk which your asset is being exposed is a fire. You that because of fire, your asset get damaged, your asset get distorted, or asset might get lost. So against that fire, you can take fire insurances. So there is specific insurance in the form of fire insurances where you are trying to insure your asset against the risk of fire. And generally, all the assets are being exposed to the risk of fire. If you think of any asset, may it be a house, may it be a godown, may it be a factory, may it be a vehicle, to there or not? Hello?
Yes,
Is
yes.
it audible?
Yes, sir. It is audible.
Yes, sir. Audible.
Actually, a call has come now. That's why I'm asking you. Okay, I'm going to the slides again. So in case of fire insurances, as I said to you, the subject matter of insurance is nothing but fire. And against fire, we are supposed to insure our assets. Similarly, just like fire insurance, there is marine insurances. We generally take into consideration the marine perils against which we can insure our assets. By marine perils, I mean the movement of goods from one place to another, either through the sea route or through the railway route or through the road transportation. And I know goods are being moved from one to another. There is supposed to be the prevalence of certain risks. That is the reason why you need to protect your goods from those kind of risks for which you need to take the marine insurances. So it basically provides protection against loss during sea voyage, and nowadays it also includes the voyage which are being carried out through the roadways as well as through the railways. Then when you are talking about the other types of insurances, the most important type of insurance that comes in our mind is the health insurance. One thing you need to remember about health insurance is that health insurance originally was started as an adjunct to the life insurances, and it was started by the LIC in the early 1990s. After that, the GIC started it as a part of the general insurances. But since 2002, the health insurance had been transformed into a separate insurance uh, um, insurance service, and accordingly nowadays you can find that there are some specialist institutions, specialist insurers who are providing such insurance. So their main business is only to provide the health insurances. So if you go on to take the health insurance from any life insurance company or any general insurance company, you might not get that much of benefit. But if you purchase the health insurance policy from any specified health insurance company like Star Health, then you are going to get much benefit out of it. So in health insurances, normally we go on to insure our health because our health is being exposed to many kinds of risk. Particularly the risk is in the form of diseases, and as you know, over the time period, number of diseases have tremendously increased. Nobody knows with what type of disease he or she will be afflicted with. So it is advisable on the part of each and every individual that they should go for the health insurances, because our health is our wealth. We need to protect our health, and if any mishappenings happen with our health, then automatically it will create an adverse situation for us as well as for those who are dependent on us. And in case of health insurance, normally the recovery from those kind of diseases with which we can be afflicted with requires a huge amount of expenditure. So if we have done the health insurances, then we can be compensated with the loss that we have suffered from by spending that huge amount of expenditure. So health insurance is also coming under the category of non-life insurances. And here also, as I said to you, it is being done for 1 year, and every year we need to renew it. Now, coming to the principles of insurance, as the business of insurance, as I have already told to you, is a mechanism to provide protection to the economic value of assets. So there are some principles of insurances. There are some principles basing upon which the business of insurance is being carried out by all the insurance companies, because the insurance companies are dealing with public money. So it is essential that they need to abide by certain principles. It is not their own money which they are dealing, it is the public money which they are dealing with. So as we have already pointed out, there are some principles of banking. So insurance is no exception also. And accordingly, we can find that all the insurance businesses or all those insurers who are carrying out the business of insurance, particularly in India and in other parts of the world, they are being abided by certain principles. They are supposed to follow certain principles. What those principles are all about, we'll have just a bird's eye view on those principles. The first principle is the principle of utmost good faith. And this principle suggests that the parties to the insurance contract, that is insured and the insurer, both the parties must have that much of trust and faith on each other. That means during the contract, actually it requires some sort of information to be disclosed by both the parties. And whichever party discloses the information which it is required to disclose, the other party should take it as truth. The other party, without any hesitation, actually takes it as true. Suppose as an insured, you are required to provide some information related to your weight, related to your health, related to your antecedents. So whatever information you will give to the insurer, at the very first sight, the insurer will accept it, because the insurer is having faith on you, having trust on you. Similarly, at the time of when the contract gets over, the insurance company, that is the insurer, gives you some promises. So whenever you get the policy bond, you can find that what benefits you can get in case the risk happens, and those are being spelled out in the bond. So whatever has been spelled out in the bond, the insurance company is bound to do all those things. So you basically accept it as truth. Whatever the company promises, you accept it as true. That is actually being explained with the help of this principle of utmost good faith, which indicates that both the parties in the insurance contract, that is insurer and insured, must have mutual faith as well as mutual trust on each other. The second one is your insurable interest. Insurable interest basically indicates the financial relation, the legal relationship to exist between the insured and the subject matter of insurance. Here, the subject matter of insurance is none other than the asset which you are supposed to insure. The asset might be a life asset or might be a non-life asset. But thing is that the insured, that is the owner of the asset, must have some sort of legal relationship. Without having any legal relationship with the asset, you cannot insure the asset. Suppose we can say that there is no legal relationship between brothers and sisters. Hello, is it audible or not audible? Somebody is written on not audible.
Yes, sir. Audible, sir.
Okay. So, Mr. Subhash Misra, you have asked whether travel insurance is coming under marine insurance. The answer is no. Because in marine insurance, we generally include the goods which move from one place to another. So, travel insurance is something different. When we are supposed to travel from one place to another, either through airways or through railways or through any other means, we are actually trying to insure ourselves for that particular travel. So, it is not coming under the marine insurances. And principal indemnity applicable life insurance applicable to all non-life insurances. Then comes the proximate cause clause. Proximate means nearest. Cause means what is the cause of loss. So whenever loss to be compensated by insurance company, the insurance company must find out cause or nearest cause of loss. Suppose you go down and some and accordingly go down, catch fire, and some of the goods get lost. That in that case, the immediate cause is fire. So basing on that, the loss amount will be compensated or loss amount will be calculated and accordingly compensation will be given. But before that, the insurance company must ensure the fire occurred. So it needs to go to all details. The fire might have occurred because of defective wires which lead to some short circuit, and because of that the fire catches, or the fire could have catched because intentionally the owner has lit fire to it. So that reason must have to be taken into consideration. So only looking at the cause fire, the loss cannot be compensated. But the cause of fire that also is needed to be investigated. That through the proximate clause. Suppose for
Sir,
the
your
loss,
voice is
you
breaking.
need to voice break uji. Okay.
Again, sir.
So proximate cause means nearest cause. That means it is the responsibility of every insurance company that before compensating for the loss, they need to find out the nearest cause. As I have already told you the example, suppose there is a fire, the goods may go down, lost or have been damaged. So it's the responsibility of the insurance company that it has to investigate how the fire.
Sir, your voice is breaking.
It is. Voice is breaking. Now is it audible?
Yes, sir. Yes, sir. Yes, sir.
So, are you clear about proximate clause or not? Or I will go on to explain it again.
Again, sir.
Are you clear? Are you clear about proximate clause, or I will explain it again?
Sir,
No, sir,
repeat
we are
it.
not clear.
Okay. Proximate clause. Proximate clause means nearest cause. That means the insurance company must have to investigate the nearest cause of loss. The nearest cause might seem to be one particular cause, but while investigating, they need to find out why that nearest cause arose. As I said to you, suppose in a godown, because of catching of fire, some goods were being destroyed. Now the investigation team of the insurance company must have to investigate why this fire occurred. Whether it has occurred because of the defective wiring, which ultimately led to the short circuit, and short circuit led to catching of fire. Or was there any intentional lighting of fire by the owner or not? So all the causes are needed to be investigated. Then only the compensation will be given. So ultimately the compensation will be given basing upon the proximate cause, that is the nearest cause. Then subrogation principle, it is a principle which is basically related to the transfer of ownership from one person to another. And it is generally applicable in case of third party insurances, which we generally come across in the motor insurances. Suppose because of the negligence of a third party, we are being affected adversely and we are at a loss. So if the third party has compensated us for it, we cannot claim the same compensation before the insurance company, because the third party has already paid to us. And the insurance company need to know it. So there we can transfer our right to the insurance company, so that our insurance company can pay that loss amount to the insurance company of the third party. That is known as your subrogation. Subrogation means transfer of ownership from one person to another. So generally this principle of subrogation is applicable to the third party insurances. So these are some of the principles of insurance basing on which the business of insurance is being carried out. And you can say that there are different types of products which are offered by the insurance companies basing upon the category of insurance they belong to, and the offering of products might be in the form of different products. You can say in case of life insurances, you have endowment products, you have whole life products, you have term insurance products, like that. And in case of non-life insurances, you can have products as per your requirements. If you want a product related to fire insurances, then you need to have such asset which you think is being exposed to the risk of fire. If you are an exporter, or if you are doing business whereby your goods are being transported from one place to another, you need to go for the marine insurances. So there are different types of marine policies which are being offered by the marine insurance companies or the general insurance companies under the category of marine insurances. So overall, this is the basic thing about the business of insurance. And we found that the insurance business is supposed to be carried out on the basis of these principles. And there can be various types of insurances basing upon the type of assets. And basically the business of insurance is there because of the prevalence of risk. If risk had not been there, then the business of insurance would not have been there. And because all our assets are being exposed to risk, the business of insurance is having utmost importance in the overall development of an economy. That is the reason why we need to know the basics of insurances. Okay. So in the next class, we'll start with the second module. The notes of this first module I will send to ma'am tomorrow. She will share it with all of you in your group. Will it be okay?
Okay, sir.
Yes, sir.
Sir, can you share?
Tomorrow I will give the first module notes. Yes, sir. But what are you saying? Again,
Can you
please
share?
repeat.
Can you share one mail ID in our among us? Anyone? Deepak or
Anyone?
yes, better Deepak or my mail ID.
So
Immediately.
you can give your mail ID to me. My WhatsApp number, just write down and give your mail ID in my WhatsApp, so that I will give that to in that mail ID.
Definitely.
My WhatsApp number is 99373 But thing is that it has to be shared to all. So whomsoever I will give, please share it with all. It is for all.
Definitely, sir. We will share immediately. No.
Okay. Thank you. Thank you very much. You just give your mail ID to me. I will send it to you. Definitely, I will send it. Thank you all for today. We are winding up. Thank you.
Thank you, sir.
Thank you, sir.